Hey guys, how you doing? It's Anthony Tejada from Preferred Real Estate Brokers and the Metal Property Group, and I'm here today with John Emead from Amerifirst Home Mortgage, and we're going to talk to you today about home loans, and John's going to help us out with a little Q&A. John, how you doing?
Doing well. How are you?
I'm good.
Hey everybody, how's everybody out there doing today? Happy Monday. You made it.
Happy Monday.
This far through the day. You'll be great.
All right, so we're going to just start right off, and I'm going to ask John a couple of questions. And my first question is, which type of loan is best?
That's a loaded question. Everybody's situation is different. I've been a lending professional in Central Florida for the last 22 years. So everybody has a unique situation, whether you're a first-time home buyer, you may be moving up, this is your second home. If you're a veteran, you've got unique benefits that are specific just to being a veteran. So to answer that question fully, the best loan program is the one that each individual qualifies for.
Right.
And what we do typically is we're going to go through a review process, let them know what their options are to make sure that we're fitting not just the best loan product for today,
Right.
but the best loan product for the years to come as well.
Okay. Now our next question will be, what is the interest rate and annual percentage rate that would be typical with these loans?
You're asking me all the hard questions today. Interest rates vary daily. Stocks and bonds compete for the same investor dollar.
Right.
And so what regulates interest rates is more likely, controlled by what happens in the bond market than just an arbitrary interest rate.
Right.
So rates are going to change. There's factors that go into everybody's unique interest rate when it's quoted by a lender.
Right.
Typically that's the loan program, so conventional or FHA or VA. The purpose of the loan, if it's to purchase a primary residence or an investment property, and then also, of course, the loan amount and some other particulars, the person's credit score, their maximum or their combined debt to income ratio. So there's a lot of things that really go into quoting an interest rate, and most folks, they think it's a one-size-fits-all, but it's really not. The annual percentage rate, or the APR, in the simplest of definition, it is the cost of the loan in the form of an interest rate. So kind of take the note rate, add the closing costs, and then that weighs out what the annual percentage rate is.
Okay.
Your APR is a one-time disclosure because you're not paying your closing costs for 30 years or 15 years. You pay them at the time that you close on your loan.
Okay. Oh, that's awesome. All right. We're going to move on to the next question. What are the discount points and origination fees? I know a lot of my clients out there want to know that specifically, especially on closing day.
Sure. So, we shouldn't want to get to closing day before they know what the origination points and discount.
Right.
But in definition, origination points are any costs associated on the lender's side, or even if they're including an appraisal, the credit report, any underwriting fees, processing fees, whatever the true cost for the lender is to actually produce that loan. So admin fees to originate that loan, that pays for the underwriters, that pays for the processors. It's not just a profit center. Per se. Discount points, that way that works is they're not paid in full percentages, so they can go in eighths or quarter increments or half point increments, but the point of a discount point in true definition is to help offset the yield for the lender on the loan, which typically will translate into a better price for the borrower. So if, let's just say a hypothetical, if the note rate offered to a client is 4.5% or 4.75%, the client has their heart set on an interest rate lower, then their lender would be able to offer them what that's going to cost in the form of a discount point to get that rate lower than whatever they're offering without having to pay discount points. Does that make sense?
Yes. For me, it does. I guess we're going to move on to the next question.
Go for it. I'm ready. I'm getting warmed up.
What are all the costs in a loan? So basically all the costs of the loan include not only the fees that go into the lender's pocket, but also the related third-party vendor fees and such.
So anybody that has or is obtaining a mortgage, by law you're supposed to obtain a loan estimate. You're supposed to get a loan estimate from your lender. They're going to disclose all of the numbers in black and white that they foresee you incurring to obtain your home financing. And so costs that you don't normally see in traditional real estate transactions, traditional by definition, what I mean is I buy your house, you're the seller, I'm the buyer, right? Typically you pay your closing cost, I pay my closing costs.
Right.
So anything that can come up on that is an appraisal. It could be a follow-up inspection sometimes. So if any work that needs to be done on the home and you agree to do that as part of my negotiation or as part of my loan conditions, then that same appraiser that does that appraisal has to do another final inspection. And a lot of times that's a fee that we don't have knowledge of that comes up.
Right.
But after loan approval, once we have the house appraisal, we start to see that that's something that could incur an additional expense.
Okay.
But as a rule of thumb, most lenders are going to disclose that. So they'll give you the ugliest side of it first.
Right.
Because everybody loves pleasant surprises.
Exactly.
So that way you'll just have a smaller amount due at closing.
Okay.
As opposed to the opposite, which is, show you a rock bottom cost, and then the next thing you know, you've got unexpected fees. It's not a pleasant surprise.
Right.
You don't win friends that way.
Exactly. And since you answered my next question, which was what is a loan estimate, I'm going to skip right ahead and say, do you offer, or is it typical to offer loan rate locks in this market?
So a loan rate lock is going to traditionally come once a client has secured a home.
Mm-hmm.
So you've already gone to work,
Right.
negotiated the details of an offer, the offer's accepted,
Right.
there is a closing date in place. The lock at that point in time is for a specified number of days.
Okay.
One of the things that we're going to start to see in the marketplace more fluidly, we currently do offer it at Amerifirst, is what's called the lock and shop program.
Right.
So you typically are going to lock in an interest rate. It's your guarantee on the interest rate. So that's, that where your rate is going to be. And then you have the opportunity, depending on what the market does in time with certain stipulations, of course, you might be able to lock in at a lower rate before closing, even though you're already locked. So it's kind of like you have the peace of mind to know these are your numbers based on XYZ sales price.
Right.
And then you would pretty much be able to have an opportunity to obtain an improvement if the market does get better. But the good news is if the market goes and it spikes,
Right.
well, you're already protected. So
Yeah.
you've got that peace of mind.
So it's beneficial one way.
It depends. The market is so fluid right now, and all things considered throughout this year, although we have had successive rate hikes, the market has kind of built in some of those buffers already.
Okay.
So even though we've seen the prime rate go up,
Right.
the market rate hasn't adjusted too much.
Okay.
So we're still kind of going in a sideways pattern.
Right.
Any great mortgage professional is going to keep their clients abreast of what the market's doing and what changes occur. It's all cyclical. If I had a crystal ball to tell you where the rates are going to be tomorrow, this would be a very expensive interview.
Right. Right. So the next question is there usually, typically in the market or dealing with your company, a prepayment penalty?
We've seen those go away.
Okay.
Very rarely do I hear of those coming up.
Okay.
There are some strange, weird, and wonderful loan programs that are out there.
Right.
Nothing, though, that is a conventional, so nothing by Fannie Mae, by Freddie Mac, by FHA, by VA, by USDA. None of your mainstream products
Right.
have any penalties as far as a prepayment penalty is concerned.
Well, that's good. That's good to know. Are you, or is usually anyone equipped to approve loans in-house?
Yeah. So Amerifirst is a direct lender.
Okay.
There's several direct lenders in town.
Okay.
A direct lender means that lender, or Amerifirst in our example, we handle all of the functions that are involved with that loan process
Okay.
internally.
Right.
So from origination to funding and servicing in our case,
Right.
as we service the loans, we take care of and handle and are involved in every step of the way. Some companies that are out there, they're basically going to find the funding source.
Mhm.
So, and then they're going to match the client with that funding source, and then that funding source is who's going to dictate when the appraisal is done, when everything else is ordered.
Right.
In our case, we handle all of that internally, so we
Right.
get to move a lot faster.
Right.
And in general, I think it's a better experience for the client overall.
Yeah, I would say so. I think being in-house, it sounds less complicated.
Yeah, I mean, it's been said that speed kills loans. So I think having all of that control internally,
Right.
it's just a better, I think it's a better fit for the client, and I think it's a better fit for, the referral partners that we work with.
Sweet. So, how much time do you typically need to fund a loan?
Great question. On average, I would say that most of our transactions are going to close within a 30-day span of time.
Okay.
From contract to closing. A lot of times we can move quicker than that if we need to.
Okay.
I've seen closings happen inside of 2 weeks.
Okay.
But really, those situations, you've got to have a client that's working with you full bore, that's
Right.
just committed to making sure that anything that's required and requested
Right.
is provided. And of course, we've got a lot of moving parts to the real estate financing puzzle. So titles involved, you've got agents that are involved, appraisers, survey companies. So it really needs to be a concerted effort on all parts. Everybody needs to come together and work for the benefit of those clients,
Right.
to make it happen fast.
Right.
But we're equipped to do that.
Okay, cool. And our final question is, I guess, in conjunction with that last one, do you guarantee on-time closings?
Guarantee is a tight word. Again, since we have so many different moving parts to that puzzle, and it's not to sound vague, if the client provides us with everything that we need, we want to close that loan as quickly as possible.
Right.
That makes everybody happy.
Right.
A lot of times we're ready to go way ahead of the closing date.
Okay.
And it's just a matter of communication, which I think is the key component to anything. So, we always look to set proper expectations. I at least have always done that in my 22 years of being in this business. And it's just one of those things where if we can move it up, great. If something comes up that we're not expecting, like, the appraiser goes out and there's a hole in the roof, that needs to be fixed before we can close. So those are things that might derail us from our initial game plan. Right. But communicating anything that comes up along the way, I think is apex to the success for everybody to be happy.
All right, sweet. All right, well, I hope that answers some of your questions, guys. Again, this is Anthony Tejada from Preferred Real Estate Brokers and the Metal Property Group, and we have John here. My number is 321-442-0102. John's number is
321-303-4769, or reach me at orlandohomeloans.com.
All right, see you guys on the
next one. Have a great afternoon.
Bye.